Hello, my name is Dr. George Mochocki. Welcome to Introduction to Business. This is an ongoing series. This week we're going to be discussing Chapter 17, Accounting. If you look at this course, it's probably tied with a course management system Blackboard. So if you look in there, I have another section for like Accounting 101 from another instructor, his YouTube, which gives you more detail. This one's going to be an overview. Um, a big picture with just so you learn the terms and concepts and how does accounting tie in to the rest of this series. Okay, what is accounting? Let's go right into the meat of it. Accounting is recording, classifying, summarizing, interpreting financial events, transactions, and organization, provide interested parties with financial information. And when I look at some of the accounting for interested party, if you're asked by anyone, accounting is the language of business because it deals with profitability, it deals with cash flow, it deals with the money. You can't have any business unless you know where the money and the expenses. So it deals with your revenue side and your expense side. Those two components are in essence or the heart of most businesses, of all businesses. Okay, now outside parties, employees, owners, credit unions, investors, government, they all are looking at the financial statements that you'll be providing. Language of business is you need to understand or hire whatever you have. Let's see, importance, cost control, higher profits, cash flow, and equity, liquidity. Okay, now let's look at, for lack of better words, let's look at the accounting system. So we know what accounting is. Now let's look at the accounting system. You have inputs, processing, output. So if I look at inputs, it's basically sales documents, all my revenue, any kind of cash flows or stream of cash that I get will basically be all my inputs. My processing involves entries into journal and then translated into ledgers and finally summarize and reviews complete a trial balance. Okay. Now my outputs will be financial statements. You'll have, and we'll talk about later, ratio, basic terms, a balance sheet, a cash flow, and management for management within the company and outside the company. Okay. Now, if I look at the integrity, is if I look at the gap, not the store with the clothing, but general accepted accounting principles, outline the procedures that are accepted in this field. What went wrong? When we talk about Enron, Fannie Mae, and everything else, they created what we would call a creative type of an accounting. Didn't follow the GAAP procedures. They kind of modified. And then when we get into the auditing, the bookkeeping, the auditing here, they, when I look at Enron, they had two branches. One did the auditing, the other one did the managerial accounting, which is the cost constraints, and which is looking at the expenses and how to save money and how to become more profitable. So the auditor would not give them a bad rating because the management side, which was making the managerial accounting, was making the money. So they kind of like looked the other way or kind of didn't go strictly with the gap, and they just modified it, for lack of better words. Okay, influence accounting and account information. Managers, we need that for financial reports, pinpoint problems, understanding cost behavior, using cost allocation and planning and controlling, using job order costing and process costing to track flow of the costs. Let me just move this over a little bit here. Using relevant information to make marketing and production decisions. I have to make sure I'm not going to just market something I'm not making any money. Remember, part of business is a profitability, it's a sustainability that I'm making money. If I'm just breaking even and I'm making any kind of return on my investment, then I should find another way of investing my money. Okay, now the government uses it for tax collection. All my books and everything else, my accounting, my revenue coming in, they'll say, George, you made so much revenue in your consulting business, you should pay so much taxes, and that's where they come up. Investors and suppliers, they look at to analyze your business. Do I give you a credit? How financially stable are you? Okay, so that takes care of influences. Now, bookkeeping, real quickly, bookkeeping is just general data entry. And more, just, double entry means that it has two places. So if I look at the balance sheet, I can look at the balance sheet and look at the numbers and say, hey, you made an error. And they'll look at me, students will look at me and say, how can you figure? Because the right side has to balance, it has to be the same as the left side. So that's your check and balance. So if I'm looking at bookkeeping, and a lot of the bookkeeping now is all done electronically through technology. You have QuickBooks, you have a lot of other software that basically takes the revenue and everything else, and already puts it in the right ledgers or journals for it. But it has to be set up properly. If it's not set up, garbage in, garbage out. If you have certain revenue going to the wrong functionality, that's because you tagged the wrong function, and then you're going to have your accounting is going to be off, and that's where the auditor will come in and say, hey, there's something wrong with your ledgers. Okay, so managerial accounting provides information and analyzed to managers inside the organization to assist them in decision making. I have to know where I could cut my expenses. If I can't, like now because of the economy, I can't raise my prices, or my competitors' prices are there, and if I raise it too much because they're very sensitive to pricing, my consumers, then I have to cut the price on my expenses side. So I have to understand the expenses accurately. So preparation, control budgets, cost of production, cost of marketing, minimizing the tax liability. So that's all as a manager. Now, financial accounting on the other side is when I look at finance, for the next chapter, responsible for acquiring funds and managing funds. Under capitalization, most businesses start off with a good idea, but they expand too quickly. They don't have enough capital to adjust to the expansion. It's good to expand, but if you're going so quickly, you don't have enough money to increase production, or increase sales, or increase your inventory, then you're going to have issues. So sometimes you have to look for the managerial. We're going too fast. You have to slow down your marketing campaign until you have the production side able to deliver what you need. Okay, so and now if I look at annual report is your yearly statement. Look at your annual report as your W-2 forms, and you submit it to the government. Here's what I actually did. Now when I look at the CPA, is certified public accountant. Now remember, auditors, they do the, for lack of better words, the forensics of the accounting. An auditor is like an English teacher. He or she could look at a thing. I could look at the numbers and look good. They could pick out, this doesn't make sense. This number here shouldn't be like this. They know the ratios. They know what for the industry makes sense. Okay, so, and you always want an independent auditor. It's like when you go for a doctor and say, give me a second opinion. Yeah, go see my partner. That's not an independent, because a partner and everything else are combined with the same organization. You want another organization, another auditor looking at your accounting books and your book to make sure that your bookkeeper is not ripping you off. The bookkeeper is doing everything underneath the GAAP procedure, and he's doing everything else following the requirements. When you read it, the annual reports, your balance sheet, income, cash flow, and your auditor's opinions. I'm not going to ask you this in here, but underqualified, nothing's wrong. Unqualified, nothing's wrong. Qualified, two irregularities. Adverse, serious, do not follow the general accounting procedures. Disclaimer, CPA unwilling to make an opinion. That means you know something wrong. They already know there's a problem, but they don't want to state it. They don't want either a lawsuit or something else, so they're just letting it slide. Okay, public versus private. You have a private accountant that they work for most organizations. Most organizations work with a single firm, a government agency, or for a non-for-profit. If I look at a private these accountants, in a lot of companies, let's look for ComEd. There's a big, they may have maybe 20 accountants for the whole organization. That's the nuclear side, everything else. But what they have, those accountants will basically utilize the public accountants as they need it, individual or business. So if I'm looking at private, they hire the public accountants, because if I need someone just for taxes, I'll hire someone that does taxes within my industry. If I need something for mergers, I'll hire a public accountant who understands all the ramifications, reading the books and everything else from a company that's going to be merged, and how do I merge the two books together so I have one unified what they call statement at the end, because now we're one company. It's like a marriage. All right, and then your CPA again is a certified public accountant. You have a lot of accountants don't have to be certified. This is hard, just like passing the law exam. It takes what, but they could have the degrees and everything else. They're just not a certified public accountant. Doesn't mean they don't understand the accounting principle. Your financial statements, your balance sheet, your income statement, and your cash flow. These three right here are the ones that you really need to know the most. If I look at our organization, I can tell the health by the balance sheet. It's the expenses and my revenue. I mean, it's my what I owe and what I bring in. So it looks at my owner's equity and cash flow. How much money's coming in? I may have enough money in savings and everything else, but I don't have enough cash on hand because all my money's tied up in investments or different parts of my process, I can't pay my bills. If I can't pay my bills on time, I pay them late. I don't pay them on time, it hurts my credit score. Okay, and that's what we talked about in the previous chapter on personal finance. Same thing. Okay, income statement looks at my revenues and it's monetary, firms, everything else I sold or bought, and net income statement basically revenue left over after or depleted after everything's paid, cost of goods sold or manufactured, cost of merchandise the firm sells, or the cost of raw materials it's used in producing items for resale. So you have to know how much is my cost of goods. Because if my cost of goods goes up, that could explain why my profitability would have dropped down. So if it goes up, how else can I reduce it to keep my what do you call it, equilibrium price for what my customers are willing to pay in check? Okay, so we have that. Now the balance sheet is what a company owns and owns at a specific time, lists the assets in order of liquidity. Remember, the asset, the most liquid, what's the most liquid asset? Is your cash. What's the second most liquid asset? Accounts receivable. Because I could take this cash and I could convert it into, I could take my accounts receivable, what they call factoring, and discount it down and sell my IOU to somebody else at a discount. He or she gets it the same terms and conditions, but now I've got cash coming in because I can convert that. When I look at, let's see, capital expenses, the house will take me longer to turn around. So cash is first, assets is anything else, liquidity, current asset, fixed asset, how quickly I can convert it within a year. Fixed assets is longer, so certain assets takes me longer to convert. I got a house, I got maybe worth $300,000 in a house. I don't have the cash, even though it just said, George, you got $300,000. It may take me a year to sell it. Now, if I had something I could sell right away, part of my furniture, people buy right away, so that's more liquid, okay? And then owner's equity, make sure you understand that asset equals liabilities plus owner's equity. So if I give you the liabilities, you just bring that over, subtract it, you know what your assets are going to be. So if I have these, I have 2 out of 3, I'll be able to solve any kind of equation. And then I look at retained earnings. When I look at retained earnings, it's money I put away. I'm not spending it, but I'm going to use it to reinvest into the operation. My cash flow problems is cash receipts distribution. Managing cash flow is a key consideration of a business. Can be particularly challenging for small business and seasonal. It looks at my operations, my investment, my finances. This cash flow helps me pay my bills on time and maintains a good credit score for me. Basic terms, make sure you know what the depreciation is. It's a write-off. Make sure future expenditure is a budget. I try to come as close as I can to the budget. It's a moving target, but I'm always adjusting to make sure either my expenses went up or my expenses went down. How do I make sure that I hit the budget that I agreed on? Make sure you know these two concepts, LIFO, FIFO, and that has to do with your inventory on hand. First in, first out profits, older, less expensive inventory. LIFO, last in, first out, lower profits, more recent goods, more expensive. Okay. Now, if I look at basic term, oh, we had that, sorry. Now, these are the ones you have to look at. If I look at the ratios, most organizations, if I look at a company, once I have my, understand my my balance and my income statement, my cash flow, I look at the liquidity ratios. And when I look at the ratio, these ratios have to be compared against someone within the industry. I cannot use my liquidity ratio, same ratios I utilize for a utility company who has a lot of high investment costs, capital costs, versus a hot dog stand who has a quicker turnaround. So when I'm looking at any of these ratios have to be compared. So if I'm comparing Walmart, I compared Walmart's ratios against Target ratio. I compare Jewel's ratios against Whole Foods ratios, or something that's close. The same thing with the current ratio. So liquidity ratio, ability to pay short-term debt, that's an asset test. Your current ratio to pay bills on time, divide current assets by current liabilities will give you my current ratio. Leverage ratios relies on borrowed fund. The extent debt is used to run a business. Most people are living on charge cards. So if I turn around this if I was a business, you're going to say, man, everything you're living at, you're not making any money, just paying off debt. And our country's getting that way. So you got to be careful when you're looking to keep on raising the debt ceiling. It's like an extension on my credit card. I have more ability to borrow. Eventually, I have to pay it off, okay? Now, profitability ratios to what you're looking. How much am I making profitability? Basic earnings per share, return on sales, return on equity, found in balance sheet and income statement. I have to understand my profitability. That's how much money I put in. If I put money into the business and I bought a new building and I'm not okay, so it's part of my expense. Now it stimulates because I have my production, I have customers coming in there. I could write that off. I could understand that. So is it profitable? What's my return on my investment? For every dollar I put in, I should get more than 2-3%. I should be, for every dollar after the business is running, I'm looking at about 50%. For every dollar I put in, I should get 150 back or more. It depends on the business and depends on your product line. Activity ratios is measures how effectively managing is turning over the inventory, and that ties in here when we get on the different statements, not here, the basic terms, LIFO and FIFO, it ties into that. And then also inventory turnover, okay? How speed your inventory is turning over. If I'm not turning over my inventory, that tells me two things. If I'm having a grocery store and my inventory for oranges, I've got a slow turnover, that tells me I have old oranges, tells me I have a poor marketing plan, tells me I got a lot of old stuff that needs to be replaced or obsolete. So I'm paying for stuff that's not moving. So I got to either write it off or do something. So this tells me, now remember, I'm looking how quickly my inventory turns over. A produce should have a faster inventory turnover than a car dealer. A car dealer may sell 2 or 3 of a certain model in a certain subgroup, and that's good for a month. But you're not seeing 1,000 like you would oranges or apples, okay? So that takes care of chapter 17. And 17, we have everything else in here. Look at the other quick YouTube I have on here, and it's about accounting. And accounting is the language of business. For a lot of people, they find it difficult. Accounting is easy. All you have to know is how to multiply. You have to understand fractions and decimals, and you have to understand some basic math. But it's the issue people have with accounting is it's very rigid. I have to follow the procedure because any accountant come in, they can see where your money's at. The government says everyone follows, even though sometimes it's cumbersome or sometimes it looks, I can find an easier way. It's very confined, very procedural. You have to do it exactly this way. So everyone reading the income statement knows exactly what went into it. Anyone looking at your balance sheet knows exactly whether you're a profit or not a profit organization. So accounting is very, if I look at careers, those are going for accounting. I think accounting, they're looking for careers entering in the next 5 to 6 years. Accounting would be the field you'd want to go into because of all the news, because of the corruption, everything else with businesses. So the government is cracking down. But what the government has done when they change all the regulations, everything else, they also, because of the Enron, the large companies that were doing things because they thought they were too big to fail, they put the same rules and everything else to small and medium businesses, and they're not the ones that caused the meltdown, but they have to follow the same rules and procedures. So now there's a bigger demand for the accountant. And remember, the pendulum swings from one side to the other. Right now, it's a lot of rules. After a while, they're going to loosen up. But for the next 5 to 7 years, accounting will be the field. So if you got an accounting degree, go into that. You're still marketable, and it's still a good area to go into. All right, so my name is Dr. George Mochocki, and this is chapter 17 in accounting, and this is just a quick overview, a large view of everything you need to know about accounting. Make sure you know the ratios, the balance sheet, income statement, financial, public versus private, and auditing and financial accounting. What's the difference between financial accounting and managerial accounting? Bookkeeping is more of just entering the data, and that's being replaced by technology, but you have to start off that way. Same thing with engineers. They start off with draftsmen so they know how to draw, understand the specifications and everything else, but it's bookkeeping. Here's the numbers in, and here's where it goes, but it's all done automatically. But you, as an accountant, have to set up the books and everything else for the software to work adequately. All right, so that's it, and I'll see you in the next chapter. I think it's either finance, chapter 18. Again, my name is Dr. George Mochocki, and welcome to chapter 17 in accounting, in a big overview.